You know, we're always told to look for companies with a high return on equity, or ROE. I mean, it's supposed to be the ultimate sign of profitability, right? Well, not so fast. Sometimes a really stellar ROE is just an illusion, a kind of magic trick hiding a whole mountain of risk. Today, we're going to peek behind the curtain. So let me just ask you this. Is all profit created equal? I mean, if two companies both have, let's say, a 25% return, does that automatically make them equally good investments? The answer is a hard no. It's the way a company gets to that return that separates a solid long-term winner from a business that could, well, just collapse under its own weight. Okay, so take a look at these two companies, Polycab and Adani Green. On the surface, they both look like pretty solid performers, but their financial DNA? Totally different. One is building its success on a really solid foundation, while the other is using a much, much riskier playbook. So let's put on our detective hats and figure out the real story behind their returns. Every good investigation, you gotta start with the foundation. In the world of finance, we call that solvency. And really, it just answers a super simple question. Can this company pay its bills? So before we even think about profits, we have to check for any financial cracks. All right, our first tool is the debt-to-equity ratio. It's simple, but it's really powerful. It just compares how much money the company has borrowed versus how much its owners have actually invested. A high number tells you the company is running on fumes, the fumes of debt. And listen, while debt can totally supercharge growth, it can also be the one thing that brings the whole structure crashing down. And here's our first bombshell clue. Adani Green has a debt-to-equity ratio of 4.52. Just let that sink in for a second. For every single dollar of its own money, it has borrowed more than $4.50. That flashing red poor rating you see on the screen, that's not just a friendly suggestion, it's a huge warning sign. Now look at this. The contrast is just, wow. Polycab's ratio is a tiny 0.02. It's practically debt-free, which is why it gets that glowing green excellent rating. And this is where our case gets really interesting, right? We have one company just fueled by massive debt and another running on its own steam. So how on earth are they both getting such strong returns? Okay, moving on to clue number 2, the profit engine. Now that we know about their foundations, we need to understand how their business models actually work. I mean, how does each company turn its day-to-day operations into cold, hard cash? So, broadly speaking, there are two main ways to run a business. You can focus on profitability. Think of like a luxury watchmaker. They sell just a few items, but for a massive profit. Or you can focus on efficiency. Think of a supermarket. They sell millions of items for just a tiny profit on each one. It's either high margin or high volume. Here's a perfect example of that volume strategy in action. Let's take a company like Nykaa. Its profit margin on each sale? Tiny, only 1.5%. But its asset turnover is really high. That just means it sells through its entire inventory more than twice a year. This is a classic efficient operator. It makes its money on speed. Now, keep this model in mind as we get back to our investigation. Okay, so we've gathered our clues, we've looked at solvency, we've looked at their business models. Now it is time for the big reveal. We're going to use a tool called the DuPont Analysis, and you can think of it like a financial X-ray that shows us exactly what's going on inside a company's books. The DuPont formula is just brilliant because it shows us the 3 big levers a company can pull to generate its returns. First up, profitability. How much do you make on each sale? Second, efficiency, or asset turnover. How quickly do you sell your stuff? And the third, and this is the crucial one, is leverage. How much debt are you using to amplify the first two? You see, pulling one lever affects the others, and the combination of all 3 gives you that final ROE number. And this table right here, this is our decoder ring. A quality compounder has high margins and low debt. It's built to last. An efficient operator has that high turnover we talked about. But the one you really have to watch out for is leveraged growth. This is the profile of a company with a kind of weak business, low margin and low turnover, that's using a mountain of debt to create the illusion of a good return. And now the case is cracked. Look at Adani Green's DuPont analysis. I mean, a 9.5% ROE doesn't look terrible at first glance, but where is it coming from? It's not from profitability, and it's definitely not from efficiency. Its asset turnover is pretty dismal. The entire return is being propped up by that massive equity multiplier of 6.45. This is a textbook leveraged growth profile. The ROE isn't from real performance. It's an illusion created by debt. Now, let's flip to the other side of the coin, Polycab, a fantastic 25.1% ROE. But what's driving it? A healthy profit margin, solid asset turnover, and it's combined with a very, very low equity multiplier. It's not leaning on debt at all. This is what a quality compounder looks like. The return is real, it's sustainable, and it's built on the actual strength of the business itself. So, the big question is, how can you use this in your own investing? Well, let's turn all these clues into a simple, actionable toolkit that you can use before you ever think about buying a stock. Here it is, your 5-point health check. First, check the foundation. Is its debt manageable? Can it easily pay the interest? Then, look at the operations. Can it pay its short-term bills? And is the business actually profitable? And then, finally, the master question we've been asking this whole time. What's the real story behind its ROE? Use that DuPont analysis to find out if it's real quality or if it's just leverage. You know, the key takeaway from all of this is actually pretty simple. A high return on equity, it isn't the final answer you're looking for. It's the clue that should make you start asking more questions. It's the beginning of your investigation, not the end. So the next time you see a stock with a fantastic ROE, I really hope you won't just take it at face value. I hope you'll just pause for a second and ask yourself, what's really hiding inside?